What's up, everybody? My name is Joe Brown, and this is Heresy Financial. You may have recently seen and may continue to see more talk of foreclosures spiking recently. And so many people have been predicting the meltdown of the housing bubble 2.0 for a year and a half or longer now, that these people are looking at this as finally proof of future vindication. Well, I'm sorry to throw a wet towel on your fire, but the rumors of the death of the housing market have been greatly exaggerated. Ready? Let's dive in. All right, ready for the scary statistic first? In September, foreclosures were up 102% year over year. So the number of foreclosures you saw in September 2020, 102% more than that September 2021. That's 24% higher month over month from August, which was already a jump from August of 2020. So foreclosures are starting to sweep the nation. Scared yet? Good. Now let's zoom out. You see that tiny little tick there in the bottom right-hand corner? That's us right now. Now here's what is vital to understand. Of course, we are seeing an uptick in foreclosures right now because forbearance ended. Of course, you're going to see a jump from last year because 2020 was unprecedented in the amount of help that came in to anybody who might default. So 2020 is going to be the bottom. But what are the numbers actually telling us? Right now, there are 1.4 million borrowers who are left in forbearance right now, and that number drops significantly every single month. And it dropped by 11% just last week. Despite this drastic drop in forbearance plans, very few people are entering foreclosure. How few? Let's look quarter by quarter. You can see that even though we are currently headed higher quarter by quarter, we are nowhere near 2019 levels. Now, we obviously have to ignore the 2020 levels because we are looking for a normal baseline, not a baseline with unprecedented levels of government stepping in to help. And even at the current exponential rate of increase, it would take over a year just to get back to 2019 levels. Now, here's the kicker. Even if every single person left in the forbearance plans enters foreclosure, what will that do to the tightest housing supply market in recent US history? Almost nothing. Because right now, like I mentioned earlier, 1.4 million borrowers still in forbearance. That represents only 2.6% of home mortgages that are remaining in an assistance plan right now. So if every single remaining one ends up foreclosing, at best, this would provide a temporary drop in prices, but most likely would basically end up being like a speed bump to prices continuing to rise. The demand is there to simply soak up the new supply as a welcome surprise. Now look, anything can happen. But from my point of view, the only thing that could cause a significant drop in housing prices would be a spike in mortgage rates. And I'm talking a massive spike in mortgage rates because you'd have to undo all of the equity that's been built over the last couple of years in the current housing market. And a spike in interest rates that severe, the Federal Reserve cannot allow because the economy and the government, like I've said a million times, is dependent on continuing to roll over the debt. We have an economy built on a foundation, a mountain of low interest rate debt that needs to continue to get rolled over. If interest rates spike, insolvency sweeps the nation, you get a deflationary death spiral. Fed can't allow it. So at least for the time being, I don't see any headwinds that are strong enough to damage the housing market. And finally, if you'd like to dip your toes into the real estate market, don't know where to start, 2 rapid fire resources. Fundrise allows you to have access to institutional grade real estate with as little as $10. And Ground Floor allows you to invest in high yield real estate loans that are sometimes up to 14%, again with as little as $10. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.